In 10 minutes, we will get the decision from the FOMC meeting about what they're going to be doing in this month of March with rate cuts. I want to spoil it for you, though, guys. They're not going to cut rates in March. That is not a big deal with this meeting. So you might be saying, Tim, if we already know what's going to happen, why is this FOMC meeting such a big deal? What does it mean for the markets? Well, at 2:30, we will be hearing from Jerome Powell live again on the updates. Where does the Fed stand as far as where the economy is, where unemployment is, where inflation? Will we see a dovish Jerome Powell and the markets take off to the upside, or will he continue to stand on the hill that says the economy is fine, we need to keep rates higher for longer? If that happens, crypto markets and the traditional markets could plummet back down. But all of that, you have to stick around through the end of the show to get all the details, as we will be covering all of that live, as well as the rest of the crypto news that are pumping the market today. But first, if you guys are friends of the channel, please help us out and smash that like button. If you're new, stick around. Consider hitting that subscribe and like as well. But first, we got to roll an intro. Welcome, everybody, to the Investing Bros live show. We're a little early today. It's 1:50, but that's because, again, we'll be covering the announcement at 2 o'clock and then the live press conference at 2:30, where Jerome Powell will take the stage, give his statements, and then answer some questions about what the future of quantitative easing and quantitative tightening looks like. Will we get rate cuts in the year 2025, and maybe how many of them? That's going to be the big topic for today's show. As you guys can see, Tshroom is back. He's with us. Tshroom, I want you to know I missed you. I'm really glad you're back, and I've decided you're not allowed to leave ever again. So in case you did not know, you're contractually obligated to be here every day from here on out till the end of time. I'm going to start with you before Smay. Tshroom, how are you doing? How was vacation for you?
Oh, it was way better than I deserved. My wife and I had a great time up in Pigeon Forge, Gatlinburg area. Beautiful, scenic mountain vistas everywhere you look. Amazing opportunities to hike and shop in America, one of America's most amazing places. I loved it. I had a great time. And I'm wearing green. It's a little bit dark here because I missed St. Patty's Day. I don't think any of us were ready for the St. Patrick's Day. This was a big one that nobody was expecting. Very impactful. So great time.
There we go. Glad to have you back. Cannot wait to get to the minute-long news wrap-up with Tshroom rather than with Tim.
Oh, yeah.
I know a lot of people miss that. Smay, my friend, though, you've been here. You never are gone. I don't think there's such a thing as a day off for Smay. How are you doing?
No, Smay never takes a day off. And I want to tell you guys, I learned a new skill over the yesterday. I started painting little miniatures.
Oh, wow.
How cute.
Isn't that actually pretty good? Anyways.
You hold it closer to the camera.
We could not see anything going on with that.
It's a Ninja Turtle?
I take your word for it.
It's a goblin. It's a goblin. Come on.
Gotcha.
There we go.
There you go.
Look at that.
There you go. There's your little goblin.
That was my first time. Hand painted. They're very small. So, I'm doing good. Thank you, Tim.
There we go. Really quickly, before we get into the news, I want to make sure you guys are aware there's a lot of chaos that's about to happen in the markets no matter what we end up deciding. Do we see dovishness from Jerome Powell? Do we see hawkishness? Either way, expect the volatility. And today's sponsor of the show is Blofin, our trading exchange. If you want to get in on it and trade, not just the FOMC meetings, but the other volatile situations as well, you can always make money in crypto trading, whether the markets are bullish or bearish. Make sure you go sign up with our link down below. Get into our VIP trading group, and we'll even give you some good trade setups. You can start trading and making money today. Shout out to Blofin. By the way, we got exciting news coming very soon with our relationship with Blofin. You do not want to miss it, but go ahead and sign up right now because you'll get all of those benefits. With that said, it is time for the news with Tshroom. So glad to have you back, man. What do we got today? What's on the docket?
Oh, Tim, we've got some very bullish news. Starting in Capitol Hill, House Majority Whip Tom Emmer says the SBR bill to acquire 1 million Bitcoin will be enacted before this Congress is over. The catch is that the Congress lasts until January 3rd, 2027. Those Congresses are quite lengthy. First Solana ETF to launch in the U.S. tomorrow. Very big big bullish news there for
Yeah.
Ethereum,
They
for
listen.
Solana.
Pause. No, I say pause. That's big news because you weren't here with us yesterday. But of course, yesterday not such a great day for Solana holders. A lot of people considered even selling their Solana after that whole advertisement shabacle. So good news for Solana holders. And I told you guys yesterday, even though there's some storms that Solana has to weather, eventually people move on, move forward. ETF coming. Very good news for Solana. I think prices will be back up sooner than later.
Absolutely. To drill in on the specifics of these ETFs, Tim, it's the first ever Solana ETF in these United States, and they're launching tomorrow from VolShares. They will track futures. One is a 2x Solana equivalent of BitO and BitX, if you're familiar. This is from Eric Bulkanis, our trusted source in the ETF world. Moving along here, we get into some more bullish news. The great state of North Carolina, let us know in the chat. Is that where you reside? They're proposing a bill allowing state to invest 10% of the public funds into Bitcoin. Very bullish. Let's keep moving. Germany just changed its constitution to create a staggering $1 trillion in new debt. Keep in mind, they do not have the world's reserve currency, the dollar. I don't know how they're doing it. This is pretty crazy. I don't know if it's unprecedented, but that's a lot of new liquidity coming into the market. Somebody thank Germany. For once. Barron's woke up and chose bullish. Cryptos could benefit if Powell signs signals that labor market shakiness and slowing consumer spending have made the central bank more open to loosening monetary policy this year. That's from Barron's, and that's why we're live right now. This exact quote. This is why the market cares, because this could send risk assets much higher, depending on what he signals today. Belgian crypto market maker Keyrock announces U.S. launch as regulatory clarity improves under President Donald Trump. SEC officially drops Ripple XRP lawsuit. A little headline then there. No, this is huge for the XRP army. Let me know. Are you an XRP hodler? This is probably the biggest news for XRP that we have had in 2025. It's absolutely massive, and we'll be talking about this a little bit more later in the show. Polymarket predicts a 99% chance the Fed will pause rates again. 99% chance. So are we going to get a cut today? There is a chance, just in this meme. So you're telling me there's a chance. Let me know what movie is this from here. If you don't know, you're dumb. Right. So, and then finally here, Bank of Japan holds interest rates at 0.5. Bank of Japan keeps rates steady as Trump tariffs casts a shadow over the economic outlook. It's a bullish day, but the Japanese say, not so fast. We know that Trump's got some more tariffs up his sleeve, so we're not going to hike rates. Well, the liquidity markets say thank you, and we will continue to move to the upside. Tim, that's our news. Japan holding their rates steady. We're about to hear from the most significant central bank, that is the FOMC, and there's a whole lot of other bullish news in there. Also, we haven't heard from our friend Tom Emmer in quite a while, but we got to hear from him today. That was a nice treat.
Yeah. Again, we're about a minute out from getting the official decision. Again, spoilers, they're going to keep rates paused. I think at the moment, the CME futures tool, if you go to my screen here, Smay, it might block. Oh, no, we're good. 99% chance that we're going to keep a pause right now on interest rates. But what's going to be very interesting, of course, is going to be how will these things respond in the next couple of months. Go off my screen for a second here. We'll be tracking what those details are. Tshroom will interrupt me if he needs to tell us the official decision. But we need to add something to what we know on this channel. Those of you who are a part of the community, you're here all the time. We know that whenever Tim goes on vacation, markets seem to pump, but we have something new to add. This morning, I got all those updates about XRP flying off the handle, Bitcoin getting back above 84,000, heading towards 85,000, while I was out hitting the golf balls out on the course. Is this the new thing too? Does Tim need to go always on a vacation to golf? Golf trips and vacations for Tim pump the markets if you guys want to start a GoFundMe and get me to permanently just live on golf courses on vacation, I'm willing to take one for the team so the markets can pump. We're going to take a look at the charts here in just a second, but it is 2 o'clock. The decision should be in. Tshroom, I don't know if you see it yet or if I'm going to let it load on my screen. You can go to my screen here, Smay. It is, I got those 3 dots. There we go, 4.5 as expected. Like we said, it is paused, ladies and gentlemen. Nothing crazy. Now, just a second ago, Bitcoin's price was 84,100. It's now about to go above 85,000. If I go to the minute chart, check out that minute chart right there, guys. That is all what has happened in the last like 20 to 30 seconds at the 2 o'clock number. Why? Some of you might be saying, Tim, why are we pumping on nothing? Because this is the FOMC day, everybody. Welcome to volatility. Put a tweet out earlier that might get me in trouble, but I'm going to repeat it again for everybody. The volatility of FOMC days is on par with the craziness of being a liberal in a Tesla parking lot. Let me know if you guys got offended and triggered in chat. I apologize for your feelings. I don't apologize for my statement. That being said, let's talk about the Bitcoin chart as a whole. We're going to zoom back in here in a second, but I want to make sure we're under the same page here. Bitcoin, we still have expectations. If you guys are in our VIP trading group, if you're with me on the trade, we are still almost a borderline perfect entry back here on the dip on March 11th. We're still looking for a move back up to resistance, a move back up into the smart trails on both the daily and the 2-daily chart, back up here towards $91,000. This is something I realistically could see happen today, especially if, maybe not didn't hit today, but if Jerome Powell stays dovish, if he comes out and says, hey, we're getting closer to cutting rates, it's just not going to happen this month, then we could hit this 91,000 the next day or two. Of course, on the long term, I'm not ready to declare a bottom in just yet. We still have that longer term sell signal in play on the 2-weekly chart. And even though we do have a green dot that has come in, that green dot without getting positive money flow or positive momentum means very little right now. That target still shows us that 74,000 is on the table. Now, if we don't get positive news from Jerome Powell, if he comes out and says, no, the economy is great, everything's Gucci, we don't need to cut rates, we need to keep them higher for longer because inflation is still the most important thing to tackle, well, forget 91,000. We might decide to flip the markets on that news and start heading down towards 74K within the next couple of days. That being said, this is an important FOMC meeting, not because of the details of what happens in March, but because of what the future looks like. Where will Jerome Powell be with all of this? Like I said, though, let's kind of focus in. Let's kind of zoom in for a little bit, get a clean looking chart here. How are we looking on a 1 hour and down, right? We already looked at the macro for Bitcoin. The resistance at 91K, support at 74. Okay, that's the big support resistance right now. What are we looking like right now? After kind of going back up here to 84.9, almost hitting 85,000, Bitcoin back down at that 84.1 level. Guess why? Because the volatility is crazy. Just finished talking about that. Some support I'm going to be keeping an eye on pretty severely here. The 1 hour support, I think, is going to be something to keep an eye. I think if we get some sort of, if it feels like Jerome Powell is saying things that are dovish, keep an eye on this zone, right? This should be a decent little level of support between 83,200, could dip all the way down here towards 82.8, but that's going to be kind of some micro support if things start to turn south during the meeting. Of course, as we've watched in other FOMC meetings, sometimes he starts saying something that's hawkish or bearish and price goes to the downside, and then he changes something up. He answers a different question kind of bullishly, and then the prices bounce back to the upside. So again, I cannot tell you yet which way, what price are going to be hit because volatility on FOMC meetings are chaos. But I can tell you the significant levels of support and resistance that are going to be things to keep an eye on. Some other things that I'm going to be watching. Guess what? Big liquidity down here at 82.9 on the lower end of that. I want to go to the 10-minute chart to kind of get a better depiction of this, though. Turn off the marker. There we go. Yeah. So big liquidity right in here. This is going to be a target that could easily get traders out of positions. Experienced traders could come down here, hit that 83,000, liquidate some of these long positions that have been entered over the last couple of hours. To the upside, resistance that I'm going to be keeping an eye on. Not saying we can't break above it, but very interesting liquidity coming up here. Let's go about 86,000. 86,000 is going to be very interesting there. Even if I come up and look at the 4-hour chart, you are going to see here a little higher, got big liquidity here, but the 4-hour smart trail with the buy signal we got here just a couple of days ago, it's giving us a target right here. And I'm not going to go all the way to the top end, but I think realistically, right in here, this level of liquidity, if I spread this out, Bitcoin easily could make its way down towards 83 or easily make its way up above 86,000. And that isn't necessarily giving us a definitive statement about which way the markets go. This is just how volatile FOMC can be during this chaotic time. So we'll be watching that when we are live, but keep an eye on how those things work. Again, hawkish, we go down, dovish, we'll go up. Extending past the day, don't be surprised, even if we're hawkish, to see some sort of bounces and misdirections here before the downward move. If we're dovish, don't be surprised to see a rally to resistance, a pullback, making everyone think things are over, and all of a sudden we make our move up to 91K. The volatility will continue no matter what the decision is, but we'll have a better understanding and probability of the direction of the markets when we hear Jerome Powell speak for himself. Before I throw it to Tshroom, we are going to go through some of the news, break it down. Again, if you're just joining us, thank you so much for being here. We are going to be covering the FOMC meeting live here in 25 minutes. But let's talk about the belle of the ball today. Let's talk about the darling crypto, and that is good old XRP. XRP, if you guys live under a rock and you're wondering, man, why did XRP take off today and get up here close to $2.60 after starting the day down here on 222? Well, officially it's sounding like after years, I mean, we're going now on over 5 years or close to 5 years of will they, won't they, who's going to win this lawsuit thing. It is sounding like officially XRP, the lawsuit that is against them from the SEC is over. Now, I don't know about the rest of you guys. I have now been going probably 567 days straight of whenever you look up News Now, right? If you go to News Now, one of my favorite places to look up crypto news, you go to the crypto link, you click on popular. Sure enough, the top links are going to be SEC drops the XRP lawsuit against Ripple, right? This one sounds legit. If anyone else uses this website, this is almost without an exception, there is always an XRP story about how the lawsuit's about to end, right? It's been that way for years. This one, though, why are we pumping? It sounds like it is officially official. We are pulling back here a little bit, again, with some of that volatility. XRP back down to 245. But the big news here, the big thing that's happening is, are we going to officially get this breakout above this resistance level? Depending on where you want to draw this line, there's a lot of different ways you could draw it. I'll put it right here. A lot of touches in there. We had a fake out on XRP back here on March 2nd. It looked like we were breaking out to the upside. Sure enough, we came right back down, bounced on our support level. XRP has been one of the coins holding up the absolute best in the crypto space. I mean, just take a look here on the daily chart at this formation. Higher lows, yes, lower highs, but higher lows coming into a symmetrical triangle pattern. Consolidation, regrouping for another big run to the upside more than likely. But when you take a look at the rest of the crypto space, even Bitcoin, lower highs and lower lows, not consolidation, downtrend. You look at Ethereum, massive downtrend. Solana, downtrend. Chainlink, downtrend. Ondo, downtrend. Cardano, downtrend. I'm just showing you guys some of the cryptos out there. I'm not going to go through every single one. There are very few coins right now that are doing what XRP is doing in its sideways symmetrical consolidation. This is majorly bullish. We talked about this before on the channel, but in case you missed it, this long-term formation could bring prices for XRP to the world of all the way up here with a flagpole, all the way up towards above $10, pushing closer towards $14. All right, not expecting this to happen next week or a month from now. In fact, I'd be very surprised if we see a $14 XRP before the end of 2025, right? I don't think that's really what I'm expecting, but maybe sometime 2026 or 2027, that is an explosive formation after years of XRP holders being suppressed and the FUD just taking over, not allowing them to ever get a breath of fresh air. XRP has exploded more recently and is showing massive signs of long-term strength. If you don't like XRP fundamentals, that's fine. You guys are more than welcome to dislike the fundamentals. Here on the Investing Bros channels, we like to make money. We like to invest in things that will make us money, and we're not perfect by any means, but this was one of the coins that we told you back down here, sub 50 cents, it's going to have an explosive day. You do not want to be fading XRP, and sure enough, since November, there's no coin with better returns on your investment than XRP is at the moment. What about some more, local targets, right? Because I just gave you a very long-term target for XRP. What about maybe what's understandable the next couple of weeks if we're bullish, right? Let's assume the if-then statement is if Jerome Powell is dovish and if we get kind of a clue that we're going to be moving into quantitative easing sometime this year, sooner or later, what are some targets that I'm watching right now? Just like the rest of the crypto space, XRP has been under a buy signal here. Green reversal, bullish momentum, positive money flow. Is it the same way on the 2-daily chart? Let's go take a look here. I don't think I've actually checked this one out. No, it was not. We actually had a sell signal on the 2-daily chart. We don't have a buy signal in just yet. We do have the green reversals. We do look like we're moving in the right direction with our momentum. We need that money flow to flow back convincingly positive, and that's going to be a good sign. But on the daily chart, we absolutely still were under a buy signal. That gives us a short-term target right now up here back towards 277 to 299, or in other words, $3, right? Back to these highs we had early in March. If we can get that 2-daily to flash bullish, well, all of a sudden, we're actually above that smart trail, right? I told you the 2-daily had a sell signal. Guess what? Sell signal came in. This Luxalgo trade ended up being perfect. We came right down into the smart trail. You can take your profits. Now it looks like we're ready to move back to the upside. Whenever you're above the smart trail and you're close to a buy signal, the best thing to do is keep an eye on resistance levels right above us, but also the red cloud up here. So that 278, 280, similar range as the daily smart trail. But the reality is we could be back up here in the next couple of weeks, back up to 340 with XRP if we start to move back into that quantitative easing situation. After that, again, there's going to be a lot of stopping points between now and $14 XRP. I do think XRP will get to $14 in the next couple of years, if not a year and some change from now. But one of the simpler things you can even do with Fibonacci extension and look at some levels to keep an eye on. When XRP sets a new high and gets up here above 338, keep an eye on these next two levels as some stopping points. $4 will be the 1.72 or 1.272 extension mark, and then the golden pocket up here at $5. So don't be surprised if XRP starts to take off to see a couple stopping points. What doesn't mean a bear market is coming, just means there should be levels to take profit and look for a little dip to buy in a little lower with your trading account using Blofin on XRP. That is what I'm seeing on that coin. Now, we're going to take a break here for a second. We might do some altcoins later on. Everything is pumping right now, but we are going to prioritize making sure we're preparing you with the news, getting into the FOMC meeting. If we have time at the end of the show and we get, we'll say today with all the views we're probably going to get, let's get to 900 likes. I'm not going to quite double it to 1,000. 900 likes, and we will do a trade setup at the end of the show for the community live. So make sure to smash that like button right now if you want to see that. With that said, I want to start off, Tshroom. Let's preface this and get into the news later. I kind of did some of it with the charts, but I want to get your opinion. What are you expecting? What are we looking for right now in the next, what time is it? We got about 18 minutes. 18 minutes till Jerome Powell takes the stage. What should people be looking forward to from hearing from him? Why is this meeting so important? And what are the if-then statements with those situations? What's your opinion there, Tshroom?
Yeah, I mean, I think the big one is what is their appetite to cut rates based on the employment data that will come out. I think there may be some questions. Are government workers that have been laid off through cutting through Doge and through other programs, the Trump's agenda to kind of downsize the government. Will that data be impacted? Will it be reflected in the unemployment number? I think that'll be a really critical question, because that can be a very highly political question that the media is very interested in interpreting for us. So that, and then also what the heck happened with the dot plots. Everything that I'm looking at is showing that there was no change in the dot plots. So that might be a bit of inside baseball for those of you just tuning in. You may not know what that means. That essentially means that the FOMC did not change their expectation of rate change in 2025, 26, and 27, and farther out from December. So in March, they think that the rates and the amount of cuts will be the same as they thought in December. So none of the data that came out since December has impacted them to change more cuts or less cuts in 2025. One analyst that I was looking at said that that the dot plots are pretty indicative of about one. You don't have to go to my screen. About two cuts in 2025. And another thing that's coming to my attention here, Tim, is the Polymarket spread. You can go to my screen now, Smay. We're kind of whips on Smay all over the place. June the June betting line here for Fed decision has completely flattened. So for the last 2 months, June has been predicted that 25 basis points would be in the lead. It's now only in the lead by 1%. May is 80 that no change, 17 that there will be a cut, and March obviously we just got the results. But this is big, Tim, because the June betting spread has now completely flattened. It's anybody's game for June.
Yeah.
Now we are in the limbo period though, right, Tim? And you originally asked me, what am I looking to hear? I'm looking to hear if we're going to get cuts. And I know that sorry sounds really simple, but that is the main thing here. Are we getting cuts in June? Is there a possibility of May? That's really what I'm looking for. And it's going to come via his, with these, how sensitive he is to questions about unemployment and government workers being included in that number on down the line. But yeah.
Yeah, I want to continue before we move on from that, because all very good stuff. You're absolutely right. You love looking at the Polymarket to kind of get the idea of where the everyday person is betting on things going. I like to look at CME futures tool to understand where kind of institutions are moving. So again, not that either one of these are going to get things 100% accurate, but they give you a good idea of things.
Sure.
And it's the same over here at the Fed, just a little bit different. Go to my screen here, Smay. Of course, it still says 99%, even though this is official March. We paused rates. May right now, a little higher than it was earlier today, coming in close to 80% likely that May will stay paused as well. And then you move to June. This is the date that a lot of people have on their calendar, and they're saying this is probably the more likely situation for when we might get a rate cut. Well, it's coming in right now, not quite the 50-50 zone that Tshroom was showing, but 36.5. I think yesterday it was in the high 20s. A couple of days before, it was in like the teens. So this can change a lot, but right now, this is not necessarily leaning towards a decision-making that would make you feel like Jerome Powell is going to come out and say, we're dovish, and going to say, hey, we're not cutting rates this month, but we're realizing we probably need to do it sooner than later. Keep an eye on May and June. That would be best case scenario, right? That would be very, very bullish. Will he say it, though? That is where we're kind of leaning and saying that is the question. And we're going to say this and we're going to move on. Of course, we're going to listen to the press conference here in just a little bit. But let's go to make our predictions. Go to our three-way screen, Smay. Let's make our predictions right now. I'm going to start with you, Tshroom. I will go last. It was Tshroom, Smay, then Tim. Predictions. Dovish, hawkish. Will we hear positivity or negativity? What are your thoughts, Tshroom?
I like to think that Jerome Powell he has respect for the institution of the Federal Reserve and what they do. I think probably, in the back of his mind, he realizes that the Federal Reserve is a failed experiment at this far into the future, inception 1913. But he has a lot of respect for the institution and its anonymity and its independence from the executive branch of the United States government. All that to say, I think more than ever in this specific press conference, I want to play the middle as much as possible out of respect for the independence of the Federal Reserve so that I can – it's not that he wants to help or hurt Trump, right? I think he wants to play exactly down the middle so that Trump can have a fair playing ground for his tariff chaos, his tariff policies. So that's really what I'm trying to do if I'm Jerome Powell. And I think he comes down right as close down the middle as possible. But it's hard to think that he won't come in and give a little bit of a hint that there are cuts in that we'll see before July. Very
interesting. Smay, what about you? How are you feeling? What are your predictions about the attitude of this meeting?
Well, I think
we'll shorten it to two.
And this is my absolute. I guarantee this is going to happen. He's gonna walk out. Okay.
Yep.
And he's gonna walk up to the podium, and he's gonna go shuffle his papers.
Yeah.
So he's gonna sigh. He's gonna look a little dejected. He's gonna sigh, and then he's gonna go, "Good afternoon," is what he's gonna start with. Okay,
this is all right.
I'm not just being. Well, hold on. I'm not just being silly here. I mean, that is the sequence of events. 100%. If I'm right, I got to get some kind of prize. If that's the exact sequence of events.
No, you don't get a prize. You're right. 100%. That is what's going to happen because it has happened the last 18 of these.
You're right, because I've seen enough of this. All right, and then I think his comments are going to be a lot more of this just very like I don't know if I would say it's either way. I think he's going to try to play it really deadpan, and I think if anything, he's going to seem exhausted. Like he's just going to seem absolutely exhausted. All of his comments are going to be very just kind of like, don't look at the what's going on. Don't worry about it. It's fine. Whatever. We're doing our job. I think that's what it's going to be.
Yeah. Before I give my answer, chat is saying here, I asked the chat, how will Powell run the press conference? I should have given a third answer here, but I said dovish, price will rally, hawkish, price will crash. Right now, 56%. Now, there's only 600 votes. We have almost 1,200 people in YouTube watching, another 750 over in X, so people need to vote right now. But 56% saying dovish, price will rally, 44% saying hawkish, price will crash. People are pretty bullish right now. I should have given a third option because I'm even, I think if you had asked me this question this morning, I probably was leaning towards dovish. But I'm kind of rethinking some things because I thought the last couple would be dovish as well. I think we're going to see a continuation of the same exact Jerome Powell we have seen for probably the last 2 or 3 of these FOMC meetings or times that he's taken the stage. And I'm cheating because he's neither going to be hawkish nor dovish. I think Jerome Powell is going to kick the can down the road again. I think he's going to answer the questions about inflation is by saying, kind of like, I love seeing inflation come down, but we're not out of the woods just yet. We're not ready to say inflation's under control. And then he's going to answer questions about the unemployment and say, unemployment's slightly up, but we're not ready to make a definitive statement just yet. We want to, and here's what he's going to say, and you want a 100% prediction because everything Smith said he's going to be true. He's also going to mention we have to read the data.
Of course.
I don't think he's going to come out and give us hope about a cut. And I don't think he's going to come out and kind of give us this pessimism like, no, we're still in trouble. I think he's going to say the economy's in a good place. Inflation's going down, and that's good, but it's not out of control. Unemployment's not out of control. We need to kick the can down the road and continue to bring in data. Volatility will reign. I don't think anyone will be satisfied at the end of this meeting. I hope I'm wrong. I hope he's definitive and dovish, but I think it's going to be boring.
Tim, I agree with you 100%. That's what I was getting at. And I think it's going to be one of those things where it's not going to be very clear either way, but all I know is that he's going to seem not super energetic about it. I think, and I'm not saying that just because that's Jerome Powell. I mean, like specifically where you're going to notice that he's just like, very like out of it and dejected. So just go into the script.
Let me show you guys some information that has printed over on Zero Hedge, has done a really good job with some more information that's come out. Because if you go to the Fed website, they have what's called the summary of economic projections. And when there's a Fed, not every Fed meeting gets a summary of economic projections, but when they do, there's an asterisk here. Again, this is on federalreserve.gov. We got one in March. So there's data to be analyzed here. If you scroll through this is the summary. This is the statement that's going to be said, and this is the summary of economic projections. It's got all kinds of information, including the dot plot. Well, Zero Hedge analyzes that really well. Powell finally found the stag inflation. That's controversial. Fed cut year-end GDP forecast from 2.1 to 1.7. That's in line with what the St. Louis Fed already released. Fed raises year-end core PCE forecast from 2.5 to 2.8. That's an increase. Is that super hot? Is that too much not to cut? That's the question. Fed raises year-end unemployment forecast from 4.3 to a very humble, I will point out, 4.4, and extremely humble, but doesn't stop there, Tim. We've got, I won't read this, but you guys can go check this out. There's a lot in this. And then this one here, this is the reason why I think we're pumping. Fed to slow balance sheet runoff starting April 1st. So this is a pretty big deal. So what is the balance sheet? This is the balance sheet. We don't need the oscillators for this. This is the treasuries that the Fed hold on their balance sheet, right? And as this goes down, the Fed is saying to the market, here are I want dollars, here are treasuries. And what does that do? That is liquidity into the market. And so this is something that could potentially be an early signal of an end to QT and a beginning of quantitative easing. As this comes down or stops coming down, I should say, and starts to level off, this takes the strain off the market. But this alone isn't enough. This is just one of the tools that the Fed has to essentially control the rate. So this is big, though. that's going to be probably asked quite a bit of questions, but it doesn't start until April 1st. So the market will begin pricing that in. I think that's probably a little bit of what we're seeing today. But remember, we're just in the hyper volatility zone right now. Nothing that you're seeing on the charts is going to necessarily be reflected into the mid to long term, meaning into the end of March, into April and May. What you're seeing today is just chaos. It's just hedge funds fighting each other and blah, blah, huge liquidity whales just thrashing around in the ocean of the stock market, right? But by the end of the week and probably mid to late next week, that's when we'll start to get an accurate reading of how the risk markets are actually digesting this information. And that's going to be very, very important.
Sure, real quickly, because I have a thought I want to kind of look at this. Could you bring back up the dot plot? You had the dot plot up earlier, and you ran through it.
I would love to bring up that dot plot, Tim.
I want to see it again, and I'll explain what my kind of thinking is here, because there was something on there that I didn't love, but I'm like, well, wait a minute, they might be projecting it based on something else. It says they're expecting PCE, or we could change that to inflation. They're expecting it now to rise, to be higher than originally expected. And they're expecting unemployment to only barely be up, right? So you might look at that at first and say, wait, so they're saying inflation's going to be up, but unemployment's not that big of a deal. Does that mean they're keeping their focus on inflation? But I want to look at that dot plot again. Show the dot plot. What is the expectation for the rate to be at the end of the year?
At the end of 2025. At the end of 2025, the majority sees it to be, and it's very, very small print. I'll go to the actual one here.
Yeah.
Little PDF frames per second here. It looks like by the end of 2025, the majority is just below 4.0. So that would be 3.75. Yeah.
2 cuts. Okay. Yeah. I'm really curious when the press conference happens. You go off the screen now, it's May, and we'll go back to our split screen. How will he answer this? The expectation of inflation or PCE being higher, is that because of tariffs? Is his expectation for inflation to be higher because of tariffs? Or is that because he's saying, no, we're going to cut rates. We're going to have QE. We're going to be cutting by probably at least, the expectation at this point is at least 2 cuts this year. We're expecting inflation to go up because we will be turning our attention to unemployment to tackle that and keep that low. And we understand that as a consequence, inflation is going to go a little higher. Which is it? Is it in response to QE, or is he saying even without QE, it looks like inflation is about to get back to the upside? That will have a big impact, I think, on how the markets kind of respond. If he's expecting inflation to go higher because of QE, well, I think that's what everyone's expecting. That's bullish. But how does he respond to tariffs? How does he respond to the economy as a whole? I love seeing these statements. If you guys appreciate Tshroom being here and being back, he can find these things that I never seem to be good at finding. I love having him here. Drop a 1 in chat if you guys miss Tshroom and love him being here on the team. I'm curious to see how this plays out, Tshroom. I'm curious to see how he does it, because I think there's evidence that says that he could come out here and be slightly hawkish, but there's other evidence that says he might be extremely dovish. And even though I just predicted down the middle, after reading and hearing those thoughts, I'll be honest with you, I'm leaning a little bit more dovish, but I still need to wait to see what he says. By the way, we're 2 minutes away from that happening. Smay, I know you had that all set up. I know we're going to have to get everything fixed when we have that come back up. You guys will be able to see my screen. We're going to watch Bitcoin's price moving while he's speaking. But anything else you want to kind of say before we get into it, Tshroom? We got 2 minutes here.
Yeah, so the bond market will be the final word here, right? Because if they cut, they've paused, right? But the bond market doesn't necessarily have to agree with that in the short and midterm. And we saw that actually with the last pause. They paused it, but the rates went up, the yields went up. So if we look at the 10-year here, it's essentially flat. It's a flat on the week. I'm drilled into the 4-hour here, which is why you see a little bit of volatility. But essentially, the bond market's saying, okay, we knew it was going to be a cut. I'm sorry, goodness, that's the third time I've said that. Yeah, we know this was going to be a pause, so it's already baked in. That's why you're seeing mostly flat movement into this event. There's a little bit of a Dumpsky candle right here, right? But this is overall telling me that the bond market has learned nothing new yet. They're waiting for the press conference. The 10-year is essentially unmoved and slightly down, but not really enough. The 3-month, pretty much the same thing. So the earlier dated bonds, pretty much the same thing. However, I am seeing much more compression here, potentially ready to break out much more viciously to one side or the other than the 10-year, which kind of has a favorability where it's kind of kind of moved and consolidated in the upper part of this range here, if that makes sense, is where it's consolidated versus the 3-month. Not so much. I suppose you could say it's actually consolidated towards the bottom part of the range. So a little bit of a little bit of an early. So what does that mean? Well, if the 3-month is staying low and the 10-month is actually kind of moving upward, well, it just means that the 10-year is probably going to be the one that folks pay attention to. And so far, it's kind of defying the Fed so far, or it started to defy the Fed earlier weeks before, and it is not yet undefying it. If it is not yet going back on that, right? Now, if we get a breakdown, here, then that's saying, okay, we're not going to fight the Fed here. We're gonna continue to move to the downside. Look, are we getting started here?
We are. I mean, real quickly, keep liquidity down here, 83,000 and 85.4. What's to watch?
Our dual mandate goals of maximum employment and stable prices
the intro.
For the benefit of the American people. The economy is strong overall and has made significant progress toward our goals over the past 2 years. Labor market conditions are solid, and inflation has moved closer to our 2% longer run goal, though it remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We also made the technical decision to slow the pace of decline in the size of our balance sheet. I'll have more to say about these decisions after briefly reviewing economic developments. Economic activity continued to expand at a solid pace in the fourth quarter of last year, with GDP rising at 2.3%. Recent indications, however, point to a moderation in consumer spending following the rapid growth seen over the second half of 2024. Surveys of households and businesses point to heightened uncertainty about the economic outlook. It remains to be seen how these developments might affect future spending and investment. In our summary of economic projections, the median participant projects GDP to rise 1.7% this year, somewhat lower than projected in December, and to rise a bit below 2% over the next 2 years. In the labor market, conditions remain solid. Payroll job gains averaged 200,000 per month over the past 3 months. The unemployment rate at 4.1% remains low and is held in a narrow range for the past year. The jobs to workers gap has held steady for several months. Wages are growing faster than inflation and at a more sustainable pace than earlier in the pandemic recovery. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance. The labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.4% at the end of this year and 4.3% over the next 2 years. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 2.8%. Some near-term measures of inflation expectations have recently moved up. We see this in both market and survey-based measures, and survey respondents, both consumers and businesses, are mentioning tariffs as a driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.7% this year and 2.2% next year, a little higher than projected in December. Is at our 2% objective. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%. Looking ahead, the new administration is in the process of implementing significant policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. It is the net effect of these policy changes that will matter for the economy and for the path of monetary policy. While there have been recent developments in some of these areas, especially trade policy, uncertainty around the changes and their effects on the economic outlook is high. As we parse the incoming information, we're focused on separating the signal from the noise as the outlook evolves. As we say in our statement, in considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We do not need to be in a hurry to adjust our policy stance, and we are well positioned to wait for greater clarity. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. An admittedly challenging exercise at this time in light of considerable uncertainty. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of this year and 3.4% at the end of next year, unchanged from December. While these individual forecasts are always subject to uncertainty, as I noted, uncertainty today is unusually elevated. And of course, these projections are not a committee plan or a decision. Policy is not on a preset course. As the economy evolves, we will adjust our policy stance in a manner that best promotes our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can maintain policy restraint for longer. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we can ease policy accordingly. Our current policy stance is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. At today's meeting, we also decided to slow the pace of decline in our balance sheet. Since we began balance sheet runoff, our securities holdings have declined by more than $2 trillion. While market indicators continue to suggest that the quantity of reserves remains abundant, we have seen some signs of increased tightness in money markets. Beginning in April, the monthly cap on Treasury redemptions will be lowered from $25 billion to $5 billion. Consistent with the committee's intention to hold primarily Treasury securities in the longer run, we are leaving the cap on agency securities unchanged. This action has no implications for our intended stance of monetary policy and should not affect the size of our balance sheet over the medium term. The committee also continued its discussions as part of our 5-year review of our monetary policy framework. At this meeting, we focused on labor market dynamics and our maximum employment goal. As we have indicated, our review will include outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference in May. Throughout this process, we will be open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up the review by late summer. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I will look forward to your questions.
Howard.
Howard Schneider with Reuters. Thanks for your time. So 2 things on sort of the real side here, inflation and then GDP. How much of the higher inflation forecast for this year is due to tariffs? And since the policy path remains the same, are you effectively reading this as a one-time price level shock?
Okay, so how much of it is tariff? So let me say that it is going to be very difficult to have a precise assessment of how much of inflation is coming from tariffs and from other, and that's already the case. You may have seen that goods inflation moved up pretty significantly in the first 2 months of the year. Trying to track that back to actual tariff increases, given what was tariffed and what was not, very, very challenging. So some of it, the answer is clearly some of it. A good part of it is coming from tariffs, but we'll be working, and so will other forecasters, to try to find the best possible way to separate non-tariff inflation from tariff inflation. In terms of your sort of looking through question, too soon to say about that. As I've mentioned, it can be the case that it's appropriate sometimes to look through inflation if it's going to go away quickly without action by us, if it's transitory. And that can be the case in the case of tariff inflation. I think that would depend on the tariff inflation moving through fairly quickly, and would depend critically as well on inflation expectations being well anchored, longer term inflation expectations being well anchored.
Well, I guess I'm looking at the out years here, and the fact that the policy path doesn't change at all, and inflation is unchanged in the out years also. Doesn't that imply you all have basically decided that there is no signal here, and that it's just we're back to transitory again?
So I think that's kind of the base case, but as I said, we really can't know that. We're going to have to see how things actually work out. And the fact that there wasn't much change, I think that's partly because you see weaker growth but higher inflation. They kind of offset, and also frankly a little bit of inertia when it comes to changing something in this highly uncertain environment. I think there is a level of inertia where you just say, maybe I'll stay where I am.
Colby. Thank you. Colby Smith with the New York Times. You just described inflation expectations as well anchored, but has your confidence in that assessment changed at all, given the increase in certain measures and the high degree of uncertainty expressed by businesses, households, and forecasters?
So on inflation expectations, of course, we do monitor inflation expectations very, very carefully, basically every source we can find, and short-term, long-term, households, businesses, forecasters, market-based. And I think the picture broadly is this. You do see increases widely in short-term inflation expectations, and people who fill out surveys and answer questionnaires are pointing to tariffs about that. If you look in the survey world, if you look a little further out, you really don't see much in the way of an increase. Longer-term inflation expectations are mostly well anchored. If you look at the New York, for example, then you have market-based, and it's the same pattern. People in markets are pricing in break-evens. Some higher inflation over the next year must be related to tariffs. We know from the surveys, but if you look out 5 years or the 5-year forward, you'll see that break-evens are either flat or actually slightly down in the case of the longer-term one. So we look at that, and we will be watching all of it very, very carefully. We do not take anything for granted. It's at the very heart of our framework, anchored inflation expectations, but that's what you see right now.
And how much weight do you put on the deterioration in consumer confidence surveys? You said recently that this is perhaps not the best indication of future spending, but I'm curious, what you think is behind this deterioration, and to what extent it could be a leading indicator for hard data.
So let's start with the hard data. We do see pretty solid hard data still. So growth looks like it's maybe moderating a bit, consumer spending moderating a bit, but still at a solid pace. Unemployment's 4.1%. Job creation most recently has been at a healthy level. Inflation has started to move up now, we think partly in response to tariffs, and there may be a delay in further progress over the course of this year. So that's the hard data. Overall, it's a solid picture. The survey data, both household and businesses, show significant rise in uncertainty and significant concerns about downside risks. So how do we think about that? And that is the question. As I mentioned the other day, as you pointed out, the relationship between survey data and actual economic activity hasn't been very tight. There have been plenty of times where people are saying very downbeat things about the economy and then going out and buying a new car. But we don't know that will be the case here. We will be watching very carefully for signs of weakness in the real data. Of course we will. But given where we are, we think our policy's in a good place to react to what comes, and we think that the right thing to do is to wait here for greater clarity about what the economy is doing.
Overwhelmingly nothing bigger so far.
Chair Powell, Chair Greenspan once defined price stability as an environment in which inflation is so low and stable over time that it doesn't materially enter into the decisions of households and firms.
Can you say that today, that we have that price stability, that households and businesses are ignoring price growth? When you see buy in advance psychology, big changes in inventories, and surveys that show consumers, at least in the short run, expect higher inflation.
So I do like that definition a lot. In fact, I used it at the recent conference where I spoke. So I think a world where people can make their daily economic decisions in businesses and they're not having to think about the possibility of significantly high inflation. We know inflation will bounce around. That is price stability. You know, I think we were getting closer and closer to that. I wouldn't say we were at that. Inflation was running around 2.5% for some time. I do think with the arrival of the tariff inflation, further progress may be delayed. The S&P doesn't really show further downward progress on inflation this year, and that's really due to the tariffs coming in. So delayed, but if you look at our forecasts, we do see ourselves getting back into the low twos in 26 and then down to 2 by 27, of course, highly uncertain. So I see progress having been made toward that, and then progress in the future. I think that progress is probably delayed for the time being.
If that's the case, why are there cuts in the S&P for 2025?
So again, people wrote down 2 cuts the last time, and they look at the they wrote down meaningful decline in growth from 2.1 to 1.7 in 2025, a tick up in the unemployment rate, so not much there, but core inflation up by 0.3, and so those two kind of balance each other out. So people, not everybody, but on balance, people wrote down similar numbers. The changes aren't that big. The other factor, though, as I mentioned, is just really high uncertainty. What would you write down? I mean, it's really hard to know how this is going to work out. And again, we think our policy is in a good place. We think it's a good place where we can move in the direction where we need to. But in the meantime, it's really appropriate to wait for further clarity. And of course, the costs of doing that, given that the economy is still solid, are very low.
Edward.
Thank you, Mr. Chairman. Edward Lawrence with Fox Business. So with near 4% unemployment rate, that should be low enough to bring people in from the sidelines in terms of hiring. But we're seeing the hiring rates have been stuck at 2023, 2024 levels. So what's going on there?
Yeah, so that's a feature has been for some time a feature of this labor market. You have pretty high participation accounting for aging. You've got wages that are consistent with 2% inflation, assuming that we're going to keep getting relatively high productivity. We've got unemployment, pretty close to its natural level. But the hiring rate is quite low, but so is the layoff rate. So you look at initial claims or layoffs, so you're not seeing people losing their jobs, but you're seeing that people who don't have a job having to wait longer and longer. And the question is, which way does that break? If we were to see a meaningful increase in layoffs, then that would probably translate fairly quickly into unemployment, because people are, it's not a big hiring market. We've been watching that, and it's just not in the data. It hasn't happened. What we've had is a low firing, low hiring situation, and it seems to be in balance now for the last 6, 7, 8 months. That's where we are. There's healthy levels of job creation too. So overall, it's a labor market that's in balance, and we watch it very carefully.
So then, have we seen the new administration's policies in the economic numbers yet? And when do you anticipate that happening?
In labor or in other?
In labor and inflation, just across the economy, have we started to see the new policies take effect in the numbers?
Only in a kind of an early way. I mean, it's only been a few months, right? For example, the layoffs that are happening here are, they're certainly meaningful to the people involved, and they may be meaningful to a particular neighborhood or region or area, but at the national level, they're not significant yet. But we don't know. We don't know how far that will go. We'll find out much more. I mentioned that you saw we've had two very strong goods inflation readings in the last 2 months, which is very unexpected. I think hard to trace it to specific tariffs, but it must have something to do with, it's either noise and it'll come back, and that's very possible too. But if it is persistent, then it must be to do with, people buying ahead of tariffs or raising prices ahead of tariffs and things like that. Those kinds of things happen, and they're very, very hard to capture because so much of it is indirect. A great example is their washing machines were tariffed in the last round of tariffs, and prices went up, but prices also went up on dryers, which were not tariffed. So the manufacturers just, they just kind of followed the crowd and raised it. So things happen very indirectly. And so there'll be a lot of work done in coming months to try to trace all that through. But ultimately, though, it's too soon to be seeing significant effects in economic data.
Craig.
Craig Torres from Bloomberg News. Thanks, Chair Powell. You said transitory price increases from tariffs are the base case. Transitory is the base case. Wasn't it the base case last time? And didn't the FOMC forecast lower inflation ahead last time? And wasn't the lesson that it quickly got into services, haircuts, daycare, everything else? And so I'm just wondering why the 9 aren't taking that on board and are cutting twice this year.
When you say last time, are you talking about the last?
Pandemic, yes, during the
Because
pandemic.
you could have been talking about the last time there were tariffs, in which case the inflation was transitory. Yeah, no, of course, we're well aware of that. And, it's still the truth. If there's an inflationary impulse that's going to go away on its own, it's not the right policy to tighten policy, because by the time you have your effect, you're in effect by design, you are lowering economic activity and employment. And if that's not necessary, you don't want to do it. In real time, as we know, it's hard to make that judgment. And we're well aware, of what happened, obviously, with the pandemic inflation. But I mean, we have to look at this as a different situation. There are differences and similarities. I mean, it's a different time. We haven't had real price stability fully reestablished yet, and we have to keep that in mind. And we also we hear that people are very reluctant to take on to allow prices to go up. At the same time, we hear that businesses are intending to pass many of these prices through. So it's hard to say how this is going to work out.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. The Bank of Canada, in its last policy statement, said monetary policy cannot offset the impacts of a trade war. What it can and must do is ensure that higher prices do not lead to ongoing inflation. I wonder if that kind of reflects your own sense of prioritization faced with higher prices and weaker growth, that the idea is you have to take care of inflation.
So we have two goals, right? We have maximum employment and price stability, and we have to balance those. And there can be situations in which they're in tension, right? And we actually have a provision in our consensus statement that says what we should do in that case. That's a very challenging situation for any central bank, and certainly for us. And so what we say that we'll do is we'll look how far each of those two goals is, each of those two measures is from its goal. And then we'll ask how long we think it might take to get back to the goal for each of them, and we'll make a judgment, because our tools work in one direction. We're either tightening or loosening. So it's a very challenging situation. Let me say, we don't have that situation right now. That's not where the economy is at all. It's also not where the forecast is. I don't know any mainstream forecasts that really show significant problems like that.
Well, just to follow up, yesterday, the UCLA Anderson forecast said there's a high probability of a recession. Where do you stand on whether or not the slowdown you're seeing creates a higher probability or concern that you may have on recession? Thank you.
There's always an unconditional possibility of a recession. It might be broadly in the range of 1 in 4 at any time. If you look back through the years, it could be within 12 months, a 1 in 4 chance of a recession. So the question is whether this current situation, those possibilities are elevated. I will say this. We don't make such a forecast. If you look at outside forecasts, forecasters have generally raised, a number of them have raised their possibility of a recession somewhat, but still at relatively moderate levels, still in the region of the traditional, because they were extremely low. If you go back 2 months, people were saying that the likelihood of a recession was extremely low. So has moved up, but it's not high.
Chris.
When will altcoin season start?
Hi, thank you. Chris Rugaber at Associated Press. As you know, I guess last night, President Trump fired 2 members of the Federal Trade Commission, an independent agency, and this could cause the kind of legal fight about the administration's power to fire independent people. If those firings stand, is that a threat to the Fed's independence? Could he do the same thing to the Fed board?
So I think I did answer that question in this very room some time ago, and I have no desire to change that answer and have nothing new for you on that today.
Well, maybe I'll have another mulligan. As you know, I wanted to go back to the consumer sentiment, particularly the inflation expectations in the University of Michigan survey. In the summer of 2022, you cited the rise in the long-term inflation expectations in that index as the reason that you went big with a 3/4 point hike. So I know you've talked about all the different measures now, but you seem to not be placing the same weight on that. And so I'm just wondering, are you dismissing that, what we saw last week from the University of Michigan, or does that carry the same weight as it did in the past?
So I mentioned it back then, but in no way did I place a huge weight on it. I think that was a ex post story, but it wasn't the case. That was a preliminary reading, and so is this. And it's also, this is that Michigan, the one you're referring to, the longer term thing. You know, we look at it, we don't dismiss data that we don't like, we force ourselves to look at it, but it is an outlier compared to market-based and compared to other survey-based assessments of longer run inflation expectations. So we got to keep that in mind. And I would just say we look at all of them, and that one's kind of an outlier, but you know, nonetheless, we take notice of it.
Thank you.
Michael McKee from Bloomberg Radio and Television. There's a worry on Wall Street that when you say you want to study the net effect of the fiscal policies we may see on the economy, that you would end up waiting too long and be behind the curve in responding to any downturn. How can you reassure people that you can spot a problem early enough unless you decide to be preemptive?
Yeah, look, we're aware of we're well aware of how things are going to evolve and the timeframes and all that, and you know, we will use our tools to foster achievement of our goals to the best we can, and of course we're going to try to be timely with that. For right now, the hard data are pretty solid. We are obviously aware of the soft sentiment data and high uncertainty, and we're watching that carefully, and we think it's a good time for us to wait for further clarity before we consider adjusting our policy stance.
Do you think it's going to be hard to get clarity in a government by tweet? I mean, do you have a feeling that at some point you actually will have a forecast you can trust?
Yes, I think we will. It's hard to say when that will be. You know, these decisions are going to be made, and they're going to be implemented, and then we'll know. At that point, we'll know what the decisions are, and we'll have to make assessments then about the implications for the economy. Those things will happen. A lot of them will happen over the course of, you know, in coming months, certainly over the course of this year, and we'll be adapting as we go.
Rachel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. At the beginning, you were talking about separating the signal from the noise and tariff inflation from non-tariff inflation. Can you walk us through what that looked like over the last couple of months, if there were specifics from the January meeting to now that helped you make those distinctions?
So when we say separating the signal from the noise, that's just a way of saying that things are highly uncertain, and that, you know, you're reading about developments. The news is full of developments of tariffs being put on and taken off and things like that. Some of that is noise in the sense that it's not really telling you anything. You're trying to extract a signal from that, and the signal is what's going to be the effect on economic activity, on inflation, on employment, and all those things. So that's really when we say signal and noise. Sorry, the second thing was?
Or similarly for tariff inflation, non-tariff inflation, ways that you're making the distinction.
That's sort of a special case of that. You know, the idea being, and I do think that the first 2 months of this year are a great example. You've got high readings for goods inflation after a string readings that average close to zero, and you have to ask, it's coming during tariffs, but you can't. It's very hard to actually scientifically go back and match up those increases and say, yes, I can prove that that's from tariffs, but it kind of has to be to some extent. Plus noise. There can be idiosyncratic readings in various categories, which will shortly reverse, and that happens too, and that could be a big piece of it. I think we'll know. In a couple of months, we'll know whether those were, where that really was from. But that's another case where I think it's going to be very, very challenging to unpack the inflation that we see over the course of this year and be able to say with confidence how much of that came from inflation and how much of it, from tariffs and how much of it didn't. But that's what we'll be doing. We'll be doing that, and so will everybody else, and we'll all be trying very hard to make that assessment. And I'm sure we will make a lot of progress on that, and we already have. But it's going to be a challenge.
Do you have a sense yet as to what, in your mind, would make something cross from noise to a signal, what that threshold would look like?
It would depend on what we're talking about. I mean, obviously, you're looking for direct evidence that particular pieces of inflation are or are clearly not caused by tariffs. For example, if it's something that was, in the service sector that was far away from anything that's tariffed, you might think, okay, well, that is, like, frankly, housing services inflation, which, by the way, has been behaving well, which for some time was kind of our problem. Now it's slow, but it's definitely, moving down in a very good way. It's more now with goods and to some extent with non-housing services inflation.
Kelly. Thanks for taking our questions, Chair Powell. Kelly O'Grady, CBS News. So consumer sentiment has dipped dramatically, but you say the economy and the hard data is still solid. What is your message to consumers that clearly disagree and don't feel that strength? Because the hard data they're looking at is their grocery bill.
Yeah. Okay, so a couple things. The grocery bill is about past inflation, really. There was inflation in 21, 2, and 3, and prices went up. The current level, it's not the change in prices. It's they're unhappy, and they're not wrong to be unhappy that prices went up quite a bit, and they're paying a lot for those things. So I think that is the fundamental fact, and has been for a long time, a couple of years, why people are unhappy with the economy. It's not that the economy is not growing. It's not that inflation is really high. It's not that unemployment is high. It's none of those things. We have, 4.1% unemployment. We've got 2% growth, and it's a pretty good economy. But people are unhappy because of the price level, and we completely understand and accept that.
And just to follow up, why are you still projecting 2 rate cuts this year if your own projections show inflation higher for longer? Does that mean you see a slowdown in economic growth as a real threat?
So I think remember we came into this with, at the December meeting, the median was 2 cuts, the median was. And so you come in and you see, broadly speaking, weaker growth but higher inflation. And they kind of balance each other out. So you think, and unemployment is there's really only a 1/10 change. So there's just not a big change in the forecast. There really isn't. Modest, meaningfully higher growth and meaningfully higher inflation, which call for different responses, right? So they cancel each other out, and people just said, okay, I'm going to stay here. But the second factor is it's so highly uncertain. Is just, we're sitting here thinking, and we obviously are in touch with businesses and households all over the country. We have an extraordinary network of contacts that come in through the reserve banks and put in the beige book, and also through contacts at the board. And we get all that, and we do understand that sentiment has fallen off pretty sharply, but economic activity has not yet. And so we're watching carefully. So I would tell people that the economy seems to be healthy. We understand that sentiment is quite negative at this time, and that probably has to do with turmoil at the beginning of an administration that's making big changes in areas of policy, and that's probably part of it. I do think the underlying unhappiness people have about the economy, though, is more about the price level.
Victoria.
Hi, Victoria Guido with Politico. I wanted to ask, first of all, if you could clarify, you were talking about how tariffs were a good part of the uptick in the inflation forecast, and I was just wondering what that specifically refers to. Is that the tariffs that have already been put in place? Is that anticipating some of the tariffs that might be coming on April 2nd? And then also, if you wouldn't mind, talking a little more about the balance sheet decision and what drove that. Did that have anything to do with expectations of how the debt ceiling, raising the debt ceiling, might affect the reserve supply?
Yeah, so in the SEP, you'll see that there's not further progress on core inflation this year. We're kind of flatlining, going sideways. We don't ask people to write down how much of this is from tariffs and how much of it is not. But some of it is from tariffs. We know that tariffs are coming in. We know that they're probably already, all forecasters have tariff inflation affecting core PCE inflation, core CPI inflation this year, without exception. I'm not aware of an exception. So it's in there. I can't tell you how much of that it is. In terms of the balance sheet, so yeah, I think, I guess the way I'd say it is, it was the flows in and out of the TGA that got us thinking about it. But as we thought about it, we really came to the view that this was a good time to make the move that we made. And broadly, committee that came around to the view that we would do the same thing we'd already done, which is I guess in June, was it June, whenever it was, we lowered the pace of QT, and we're just going to do that again. We're going to cut it roughly in half. And the sense of that is, if you're cutting the pace of QT roughly in half, then the runway is probably doubled. Okay, so it's going to be slower for longer. And people really like that. People thought that's a good idea. It's like a plane. You can think of it like a plane coming in for a landing. As we get closer, and by the way, we still think that reserves are abundant, although you begin to see some of the things we look at begin to react a little bit, but we still think that they're abundant. And of course, now the TGA is emptying out, so reserves are higher now, so you can't really see the underlying signal. So we came around to the view, and it had a lot of appeal, and so we did it. It has no implications at all for monetary policy. It has no implications at all for the ultimate size of the balance sheet. It isn't sending a signal in any hidden way that you can try to tease out. It's just not there. We're basically, it's very consistent with our plans and our practices that we've published and that we've followed since we began this, what is a very successful rundown of the balance sheet. Again, the second time that we've slowed the pace, and we've said that we would stop when we were somewhat above the level we judge as ample. And clearly we're not at that level yet, but we're going to be approaching it more slowly. It's a common sense kind of a thing, and it had pretty broad appeal, I will say.
Claire. Claire Jones, Financial Times. You said in January, Chair Powell, that inflation expectations remained well anchored. Would you still say they remain well anchored today? And just to reiterate the question others have asked, if they're not so well anchored, why hasn't there been a more radical shift to the policy path today? Thank you.
So when we talk about inflation expectations being well anchored, we're talking about longer run inflation expectations. And they really haven't moved much, I mean, if at all. There's one reading that everyone's focusing on that it's higher, but the other survey readings and the market-based readings all show relatively, well-anchored inflation expectations. You would expect that expectations of inflation over the course of a year would move around because conditions change, and in this case, we have tariffs coming in. We don't know how big, what speed, there's so many things we don't know, but we kind of know there are going to be tariffs, and they tend to bring growth down, they tend to bring inflation up in the first instance. So I would say, I'm not dismissing what we're seeing in short-term inflation expectations. We, as I mentioned, follow that very carefully. But when we say expectations are well anchored, we're really looking at longer terms, 5-year and out, and there's really no story to tell 5 years and out, either in market-based or in surveys. But we'll watch it. I mean, we're not we're not going to miss any evidence that longer term or medium term inflation expectations are moving.
Neil.
Hi, Chair Powell. Neil Irwin with Axios. Treasury Secretary Bessent has observed that a large share of job growth over the last couple of years has been in what he calls government or government-adjacent sectors, healthcare, education. Do you agree that there's some weakness in underlying private job growth, and do you see the composition of job growth as something that has policy implications?
So that has been the case. We talked about that over the course of the last year. There were some good number of months and times when a lot of the job creation was concentrated in, educational institutions, healthcare, state governments, things like that. There were also times when private sector job growth has been moving in a healthy range. I mean, they're all jobs, but and remember, we're at very low unemployment for quite a time now. So I think it's a good labor market, but it's something that we monitor carefully. From our standpoint, employment is employment. But the elected government is entitled to have, we don't have policies that address different kinds of employment, but the elected government has a different role, and they can have those.
Can I do a quick QT question? Does the committee envision at some point tapering the MBS runoff as well?
I think tapering it, I don't know. There's no plan to do that. At a certain point, we'll stop runoff. And we may or may not stop MBS runoff, though, because, we want to stop runoff in net at some point. We haven't made any decisions about that. We want the MBS to roll off our balance sheet. We really strongly desire that. So, but we haven't made any decisions about that. I think we'd look carefully at letting that keep going, but hold the overall size of the balance sheet in, constant at some point, a point that we're not out yet.
Simon.
Simon Rabinovich with The Economist. Thank you, Chair Powell. Several times today you've said that you feel you're well positioned to wait for greater clarity. At the same time, you could point to quite a few growth risks at the moment. We've seen a stock market that's gone quite wobbly, rapidly cooling housing sales, plunge in confidence surveys. Today, not only did the S&P mark down the growth outlook, 17 of 19 see risks to the downside. So my question is, how confident are you that you're well positioned, or is that one more thing that you're uncertain about?
I'm confident that we're well positioned in the sense that we're well positioned to move in the direction we'll need to move. I don't know anyone who has a lot of confidence in their forecast. I mean, the point is we are at, we're at a place where we can cut, or we can hold what is clearly a restrictive stance of policy, and that's what I mean. I think that's well positioned. Forecasting right now, forecasting is always very, very hard, and in the current situation, I just think uncertainty is remarkably high.
And sorry, standing here today, would you be surprised to pivot back towards rate cuts in May?
I think we're not going to be in any hurry to move, and as I mentioned, I think we're well positioned to wait for further clarity, and not in any hurry.
Straight down the middle.
Matt Egan with CNN. Thank you, Chair Powell. The Fed statement released today removed a line that previously said the committee judges that the risks to achieving its employment and inflation goals are roughly in balance. Can you explain the decision to remove that line? Does it mean that you're now more concerned about inflation or about employment?
Actually, it does not mean either of those things. Sometimes with language, it lives its useful life, and then we take it off, and that was the case here. There's really not meant to be any signal here. Over the past year, conveying the sense of the balance of risks was important, that they be in balance or close to being in balance. That was useful as we approached liftoff, if you remember, but we're past that. I'm sorry, no, beginning to cut. So we just took it out. I actually would say that the more important thing now about risks, and this is in the pages like 10, 11, 12 of the SEP, if you look, participants widely raised their estimate of the risks to of uncertainty, but also of the risks to growth and our employment and inflation mandates. That's a more salient point now than whether they're in balance.
Just on the stock market has obviously declined significantly since the Fed last met. Are you concerned at all about some of the market volatility having a real economic impact in terms of hurting business spending or consumer spending, especially among higher income households?
So financial conditions matter to us because, financial conditions are the main channel to the real economy through which our policy has its effects. So they're important. But what matters from a Fed standpoint for the macro economy is material changes to overall financial conditions that are persistent, that last for a while, long enough to actually affect economic activity. So that's what we're looking for. I'm not going to opine on the appropriate level of any market, equity, debt, commodities, or anything like that. And I would just point you to the bigger picture again. The real economy, the hard data, are still in reasonably good shape. It's the soft data, it's the surveys that are showing, significant concerns, downside risks, and those kind of things. We don't dismiss that. We're watching it carefully, but we don't want to get ahead of that. We want to focus on the hard data. If that's going to affect the hard data, we should know it very quickly, and of course we'll understand that. But you don't see that yet.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. As you look to navigate higher inflation and lower growth, the Fed has talked about heeding the lessons from the 1970s. Is the Fed willing to have a recession if it means breaking the back of inflation?
Well, fortunately, we're in a situation where we have seen inflation move down from higher levels to pretty close to 2%. While the unemployment rate has remained very consistent with full employment, 4.1%. So we now have inflation coming in from an exogenous source, but the underlying inflationary picture before that was, basically 2.5% inflation, I would say, and 2% growth and 4% unemployment. So that's what we did. That's what together the economy accomplished. So I don't see any reason to think that we're looking at a replay of the 70s or anything like that. Inflation, underlying inflation is still running in the 2s with probably a little bit of a pickup associated with tariffs. So I don't think we're facing, I wouldn't say we're in a situation that's remotely comparable to that.
And last month, the idea of a Doge dividend was proposed, which would send $5,000 checks to every taxpayer from Doge savings. President Trump and Elon Musk have supported this. There's reports there could be a bill introduced on Capitol Hill. What impact might that have on household savings and spending in terms of your growth and outlook for inflation?
It's not appropriate for me to speculate on political ideas or fiscal policy for that matter, so I'm gonna pass on that one. Thank you.
Daniel.
Hi, Chair Powell. Daniel Avis from Agence France-Presse. You mentioned that tariffs are already having at least some impact on inflation. I'm just wondering how you and your colleagues on the FOMC have been thinking about the possibility of retaliatory tariffs from other countries, especially with April the 2nd coming up. Was it something you considered during this meeting? Thanks.
So since the very beginning, we've had kind of a placeholder. The staff has a placeholder of a range of possible outcomes from tariffs and from trade policy generally, and they generally assume full retaliation in those, and so that's kind of baked into the numbers. What happens? It will be complicated, and there will be some retaliation and some not, and all that. But ultimately, they're trying to, with the placeholder, give us a broad sense of what this might look like. When we actually know the specifics, we'll be able to have still uncertain, but better informed forecasts. So yes, that's in there.
Last question goes to Jean.
Hi, Chair Powell.
Last question.
Jean Young with MNI Market News. Had a couple questions on the balance sheet change that you made. So the minutes had initially described your discussion on slowing QT as temporary until the debt ceiling is resolved. But from what you said earlier, it doesn't sound like there's a desire to kind of regain the pace of QT that we have at the moment after the debt ceiling is resolved. Is that the case?
Yeah, so we looked at pausing and we looked at slowing, and really people came together very strongly behind slowing, not pausing. for a variety of reasons. And so people really came to be, pretty strongly in favor of this move. Slows down the path and probably lengthens it, doubles it effectively by slowing by half. That people thought that's a good place to be. It'll help us assure that this path is a smooth one as we get closer and closer to that. So that's how that came about.
Well, I guess my question is more, was that meant to be a temporary measure during the debt ceiling episode, or?
It was the TGA flows, Treasury General Account flows, that got us thinking about this. But the more we thought about it, we came around to this. And it is, yes, it was provoked. The original discussion was provoked by that. But I think what we came up with, though, was broader than that and different than that. It does address that issue, but it really is also, it fits in really nicely with our principles and our plans and the things we've done before and the things we said we would do. So that's why, pretty strong support. I'd just say it's nothing to do with monetary policy, nothing to do with the size of the balance sheet. It's just kind of a common sense adjustment as you get closer and closer. Let's slow down a little bit again, and that way we'll be more and more confident that we're getting where we need to get. You can take our time getting there. We're shrinking the balance sheet every month, and we think it was a good play, and as I mentioned, well supported. Thanks very much.
There we go. So we're going to give our thoughts here in a second. Clearly, Bitcoin. Go to my screen here real quick, Smay. Bitcoin doing some cool stuff here, getting up there, kissing. Did we kiss 86,000 on the? No, we missed it. 85,987. Right? There's some liquidations up here. If you guys remember early in the show, I told you we could make our way above 86K to a 4-hour smart trail. Didn't quite get there, though, right? Didn't quite get there. Did not go down, though, to the support level. Overwhelmingly, while we were live, we were very bullish there on Bitcoin. Something I was pointing out to you guys also, I'll show two things and we're going to give our thoughts. Don't sleep on this. Let's see how the day closes. But remember, we were telling you guys about, let's get rid of these, just get them out of the way for a second. We were telling you about the 220-day SMAs yesterday, talking about that pretty heavily. Kind of mentioned it today. These have been serving as resistance for, really since back here. When we lost them on March 9th, we rejected on March 10th. And then look at that. Every single day since March 10th, we have risen to the 200 daily SMA, fallen, risen, fallen, risen, fallen, gotten above, fallen, risen, fall. Now we are having a good chance to potentially be able to conquer those with today's daily candle close. Above them would be very, very big. I did show you guys on that minute chart, if you guys were not really understanding what I was communicating, this higher high that came in along with the oscillators putting in lower highs does signal bearish divergence. Not a big deal. I was kind of putting this target in here down towards 85,000. Guess where we're heading right now? That's going to be the smart trail from that 1 minute sell signal. Not the end of the world, just means, hey, if you're bullish about what was just said, we'll break down what we think in a second. But if you're bullish, that looks like a nice little support level here on 85,000. You're not seeing the same bearish signals necessarily coming yet from like the 5 minute and so on and so forth. Oh, actually, I say that. 5 minute is going bearish now. Okay, let's take a look at there. That's going to stay down here. You still could see 85,000 be the zone to keep an eye on. Let's just make sure our higher time frames still bullish. Are they bearish? 15's good. 1 hour, good. Nothing crazy there. We didn't quite touch that 4-hour smart trail just yet. Again, that's something I still think is on the way, a resistance touch there. If we had rallied and touched the 4-hour smart trail up here closer towards 87, then I wouldn't be surprised at all to see, after all that we just saw, we know volatility is a very likely thing. I wouldn't be surprised to see that lead to some sort of correction. Usually volatility lasts about another 24 hours after these meetings. But that is what we kind of saw happen with Bitcoin. I was also tracking temporarily. I was tracking the S&P 500. If you guys go over here, it got pretty high during the meeting. Is correcting here, but got over 5,700. Gold made its way. Where did it get to? It did get over $3,050. Wow. Of course, it's correcting right now. Things are coming back down as the meeting's coming to end. Things got a little bit slight on these lower time frames, a little overbought. We're coming down. Overall, though, whether we think the meeting was bullish or not, the markets responded bullishly during the meeting. They are now correcting in the moments coming afterwards. Again, keep an eye on that 5-minute smart show right now. Just below 85,000 is actually going to be kind of what I'm watching here. 84.8, give or take. Keep an eye on the purple line here. 84.3, 200-day SMA. The red line, 85.1. That's the 20-day SMA. Very important that Bitcoin closes today's candles at 8 p.m. above at least the purple line, but I really love to see Bitcoin close above that red line as well for the bulls to make that push towards 90K. That being said, go off my chart here for a second. Make sure, guys, to smash that like button also. I know the meeting's over. We're about to give our takes, but whether you stick around for our takes or you got to head out, help us out. Smash that like button. If you're new here and you enjoyed being with us, make sure to hit subscribe. We're almost to 50,000 subscribers, but we need your help. Go subscribe and also check out Blofin if you want to start trading the crypto markets with us today. Link in the description. Tshroom, I'm going to start off with you. Got 2 minutes here. What are your overall thoughts here? Don't go into details and statements just yet. Just give me your overall perspective of what you heard and how this is making you feel right now. Tell me your emotions. I'm just kidding. What do you think of this?
Extremely moderate emotions. I think that it was right down the middle, just as I thought it was going to be. I think that Jerome Powell had a ton of incentive to just be right down the middle. Again, kind of to lay the platform for Trump to build on. It's not going to be a good for the level of complexity that Scott Bessent at the Treasury and Donald Trump are trying to assemble a real structure to attack the $30 trillion of debt. And that's not an easy task. I think the Fed is trying to create some stability here, keep the interest rates paused. It would obviously work in the favor of Donald Trump for those rates to come down. But I think Jerome Powell also, he's beholden to the dual mandate. He's not going to do something just to lay it up for an incoming administration. He wants to just keep it stable, I think. And he has every incentive to do so. That's what the data is showing him. He's got the strong unemployment, strong inflation, which hasn't really changed much since December. That's true. So it's just play the middle. And, you could also, describe that as kicking the can down the road. I think that's a little bit more negative, but you could also describe it that way. I think it's just play the middle, let Trump control all the variables you can, just keep them the same so that Trump can get in there and, do whatever he's going to do with the tariffs. I don't think that Jerome necessarily thinks that Trump will be successful with them, but I think he knows enough to say, let me just stay out of it for now, pause. Definitely not going to hike, but I'm also not going to take extreme action on the balance sheet by letting that run off too much. But we will continue to slow that. That's important, going from 25 to 5 billion runoff. That's going to be pretty important. So yeah, I think it's just play the middle and let Trump do his thing.
Yeah, we're going to get into some details here about them, but there's 4 factions and topics that kind of got brought up and things that were happening. We talked unemployment like we thought we would, right? I think that overwhelmingly his responses in answering questions about unemployment came across very dovish / bullish. Even that concept, and we're going to get the details here, but he doesn't see unemployment being a big issue to end 2025 or 2026. So that's bullish. They got to do things to slow that down. That's bullish. Him talking about tariffs bringing uncertainty, that's bearish, but stay tuned on that one because I'm going to bring that one back up. His thoughts on inflation. I'm going to lean bearish. The way he talked about inflation, inflation coming down. If he's expecting PCE to end at 2.7 in 2025 and then 2.2 in 2026, you're not going to be able to do that without some sort of tightening. Like, he's not going to go crazy with quantitative easing and cutting rates. So we're going to get that to the bearish. But then when you talk about recession overall, and I don't know who else picked up on this. I know chat was talking about it, but was there not an overwhelming feeling that a lot of these reporters wanted him to come out and just trash the Trump administration and everything going on, including the tariffs, right? As a whole, the tariff thing, he says, hey, tariffs are bringing uncertainty. But there were several questions worded very specifically saying, don't you think Trump sucks? Don't you think Trump's administration is bad? Tell us it's bad and tell us everything's going to go wrong because of Trump. And as much as Powell is not a Trump fan, we've seen Trump doesn't like Powell. Powell doesn't like Trump. That's very clear. He refused to take the bait on those claims. I see it as being bullish. So I'm almost in a scorecard situation. Let's talk about the details. 4 big things happened 2 of them, I'm going to give an edge to the bearish side. 2 of them, I'm going to give an edge to the bullish side. Obviously, that's net neutral. It's kind of mid. I think you hit it right on the head there as well. But I really want to get into those conversations with you, get your thoughts on them overall. But Tshroom, I'm going to throw it back to you and let you respond to some of what I just said right there.
Yeah. I'm loving the chat in here saying I agree with Tshroom, very mild. Yeah, so there was a quote here from Zero Hedge. He said, recession odds have moved up, but are not very high. And then Zero Hedge commented his own little opinion commentary, Fed press corps getting even angrier now. So, yeah, I mean, the press corps has an incentive to cause sensation, right? And they want to try to get a soundbite of Jerome Powell saying something negative about Donald Trump. They did not achieve that today, right? They got several no comments on those types of questions. And on matters that Jerome should address, like recession, he essentially played at the middle, right? He said, yeah, there's some indicators that the recession could be coming, but they're not very high, right? The odds have moved up, but they're not very high, was his exact quote. So, when it comes to the R word, the big scary R word, and then the S word, right? Stagflation, where you have unemployment, high unemployment and high inflation. Did the Fed revise unemployment higher? Yes. Is that bad? Yes. Did they revise inflation higher? Yes. Is that bad? Yes. Does that necessarily mean we're going to go into a German-style death spiral or a Zimbabwe-style like hyperinflation? No, that's not what that means. But yes, the indicators are going slightly in a negative direction. I thought another really important point was that when he was asked, have we started to see the effects of the new administration, the Trump administration, in the data yet? He was honest about that. He said pretty much no, right? I'm paraphrasing, pretty much no. That is an important point, right? Because the tariffs really haven't even really implemented yet. There's just been, I mean, we could talk about tariffs all day and Trump's use of them, but I do think that that's an important point that we'll be hearing more about in May, for sure. So, that's kind of the way that I'm thinking about it. And it's, again, just right down the middle.
Listen, I think when it comes to Powell, if you dislike some of the decision-making he leads, which, by the way, he doesn't make all these decisions by himself. He's the spokesperson, the chairman, but there's a team that's voting on this. But if you don't like Powell for some of the decisions he's made, listen, I've had some critiques for him over the years. I thought that back in early 2022, he was way too slow to start raising rates. I think there was some fishiness right there before the election. Of course, he's not the only person involved with how the Fed moves, but there were some weird decisions made right before the election in 2024 that would, some people believe that it looked like he was trying to make the Biden administration still look successful and everything's good. That being said, like his decision-making or not, like him as a person or not, and a lot of people are probably MAGA supporters, Trump supporters. Trump does not like Jerome Powell, so MAGA people are more than likely probably on the I don't like Jerome Powell trade. You got to respect his stick-to-itness. Like, again, does he make the right decisions? That's a different conversation. But I genuinely am watching this man and the decision that he's coming to and the way he answers questions and what questions he avoids. He has a job. I think he is doing the best he can to do his job and not worry about any of the other fluff. Again, it is no secret. Watch some of his other press conferences. He is not a fan of Donald Trump. He doesn't want to talk about Donald Trump. No one who dislikes Donald Trump would be upset with him. No one could blame him for wanting to add fire to the flames and say, yeah, I think Donald Trump's a problem. Hey, I think these policy things are in trouble. He does his job, though. He refuses to comment on those things, and you got to respect him for that situation. But with that said, let's get into it. Let's get into my 4 things, and we'll kind of break it down here. Bitcoin finding some support there around 85,000 at the moment. Number 1, unemployment, okay? I said this was bullish, right? So the concept and what you talk about with unemployment, they're expecting it to get to about 4.4 to end 2025, but then by the end of 2026, expectations are 4.3. Now, he's very clear. All these data points can change. All the expectations can change as things come out. But as it is right now, he is expecting that to stay the same. Why is this bullish? Because under current trajectory and the way things are going, unemployment numbers should increase. The only way to stop them from increasing is by restricting. There's a couple ways to do it, but one of the ways that he has with his ability is to stop tightening all of the interest rates, to start loosening things up to allow companies to get back to hiring individuals and lower that unemployment number. That in and of itself, somewhat bullish right there. You move into the PCE conversation, though. Again, he kind of talked about how we think inflation is going to be a little higher to end this year, but he's expecting the way this is going to work, PCE is going to be at 2.7 to end the year and then down to 2.2 in 2026. That's going to be very hard to do under an extended quantitative easing situation. Again, data can change. Other things can factor in where we can cut rates and still fix inflation. But that's going to make you think, man, that could make him expect, or if he wants that 2.2 by the end of 2026, he might have to stay a little tighter for a little longer. So we kind of see those balance out there. Kind of a bullish response in his response to unemployment, but kind of that's not necessarily what we want to hear with expectation on inflation. You move into the tariff conversation, you move into the Trump thing overall. I'll say this again. It seemed at times that he was blaming the tariffs for his answers of kicking the can down the road. I told you beforehand I thought he was going to kick the can down the road. He doesn't want to give us definitive statements. He wants us to feel confused. He wants us to not really know what's happening next. He's going to be very political with how he answers questions. But it did have that feeling at times where he kept saying, like, well, because the tariffs are going to put us in a transitory spot, we really just don't know. That's the uncertainty. The uncertainty of what comes in the future is going to be blamed on tariffs. You got to kind of put that in the bearish category. But again, as I said several times now, when cornered and pushed to say that tariffs are bad, that Trump's administration is bad, heck, even the Doge refund could put pressure and harm on inflation numbers, he refused to comment. He left it in saying, hey, that at the moment is not something we can count on. I'm not going to say those things are bad. That's out of my purview, so therefore I'm not going to answer. That is bullish. I think overall, I think he did a very good job of not biting on all of the pressured questions to try to get him to say that Trump is bad. I think another one in there is they tried to push him with inflation, like with the Michigan report, right? The Michigan report recently came out last week or something, expecting massive inflation. And if you want to say that the current administration and the current team is doing a bad job, just jump on that train and say, yeah, we are expecting inflation to go out of control. And he pretty much said, yeah, that was like an X post. That data doesn't really mean anything. Crushing the ground that liberals are standing on to say that Trump is such a bad president. His team is so bad. If Trump is good, then inflation is going to stay low. If Trump is bad, then yeah, Trump can make things go really, really bad and go crazy. And that's what the Michigan Consumer Report was saying. Inflation is about to skyrocket under these terrible Trump policies. Jerome Powell refused to say that was accurate. He even said that information is not really that important or even helpful. That's got to make some of us feel bullish right now about where things are going. Overall, while we got to my destination a different way than I thought we'd get there, I think it's fair. Smay, you commented here as well. Tshroom, you comment. Chat, you comment. Was I right in saying that this was going to be a not nothing burger because there was important data, but a neutral, nothing, kick the can down the road, let's make the hard decisions later kind of meeting? I'm kind of reading this whole thing like that. What do you think, Tshroom?
Yeah, I think it's you're right, asterisks, right? Because the slowing of QT, that is an incremental movement. And he's felt so good about that. Whenever he answered the questions about that, he's like, oh, we had a really good consensus. People felt great about that rather than pausing. And who knows? I mean, that's a kind of a small preference, I suppose. But that is incremental. Overall, this was, one big nothing burger other than the slowing of the QT off the balance sheet, right? Slowing the pace at which they are buying treasuries, okay? So that's really important. And eventually, what QE is selling treasuries. Okay, so that's going to be when that starts happening. So QE is buying treasuries, injecting the market with cash, saying, "Here's dollars, I'll take your treasuries back." What they're doing right now is the opposite of that, and they've just announced that that's going to be slowing. Sometimes these things are. We've been doing this for a couple hours now, so we get these things mixed up. But that is the one thing that I don't. It's a little bit of a small of a cliff note, but in my mind, that is an incremental movement in the direction of ending QT altogether, and more importantly, beginning QE.
All right, let's bring up Smay. Smay is in chat. vying for his own victory here in predictions. I'm not going to say this. Someone with the Investing Bros account just commented that technically Smay was the most right. Who that might be, we have no idea. That is allegedly Smay, but we don't know for certain. Smay, make your case why you were the most right.
I was the most right because I said everything that exactly happened. I literally said, and that's why I agreed with you, because you said what I said after I said it. So yeah, that's totally fine. I didn't say it as specifically as you put it, where you said, "Oh, it's going to be a specifically nothing burger." But when you asked me if it was going to be dovish or hawkish, I said, "It's not really going to be. He's going to kind of avoid everything altogether. It's going to be somewhere in the middle." That's what I said.
Okay,
I was first, so
you're not wrong.
Okay,
so your case is because you were more vague, you were more accurate.
No, because vague is one thing. Okay, Tim.
Well, you said that was your word, not mine. You said vague.
Vague is one thing, but you gave two options. I picked a third. I was the first one. I blazed that trail, but then you took the third. So that's me. But I'll show you guys real quick. Also, my main prediction was how he was going to do the intro. I have it here first, guys. Live footage coming in. Play-by-play here. He walks in.
Oh, he walks in. Right. He did walk in.
Fiddles with the papers.
Yep.
Right. Sigh. Good afternoon. Bam. Bam.
Wow.
Bam.
Wow.
Only thing I didn't
You heard it
get.
here first. Smay is the people's champ. He got everything right. Okay, crystal ball Smay, where's Bitcoin going next? Please help us.
Bitcoin, guys, listen. Where's Bitcoin out right now?
Bitcoin is at 85.3. It got up to almost 86,000. It dipped down to 85,000. Which gets hit first? 84,000 or 87,000?
84,000.
Wow, he's the bear. Okay.
All right. Anyways, back to you.
Everybody short the market, I guess. May says short the market. We're going to 84K. I think the other direction. Again, I'm looking at that 4-hour chart. I think there's a good chance. Go back to my screen here. Love to be wrong, Smay. Maybe you're right. But I still think with how close we are with some momentum we've made here, what actually would make the most sense to me is to come up and tap this, deal with getting that buy signal out of the way. Then we can make the decision. We want to keep going up, or do we want to make our move back down to the downside? But don't be surprised to see the 4-hour smart trail touched before the next decision. Whether we decide to correct and go all the way down to 74,000 because this was a net kind of neutral thing, sure. But I think getting that touch the upside would make sense. Then the question becomes, what happens after the daily chart gets fixed? We're still in this trade right here. I'm leaning towards 91K, but 88 is going to be something to start with. 87 is going to be something to start with before we make any decisions. 74 or 91, tell us in the chat which one happens first. Tell us if you're shorting with Smay or if you're longing with Tim. With that said, guys, that is going to wrap up today's show. It's been a long one. We've been live since 1:50, so we're going to go take a break. We will be back tomorrow, though, live at our normal time, 3 p.m. Eastern Standard Time. Make sure to smash that like on the way out. Hit the subscribe button so you don't miss any of our content, as we are here every single day talking about what's the most important details in the markets, whether rain or shine, whether the news is boring or really exciting. We are always here. You found a great community to be a part of. Join our free Discord as well, where the conversation never stops. See you tomorrow, everybody. Adios.